Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Erian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. Welcome back to another episode of Forward Guidance. And joining me today is Mohamed El-Erian, the president of Queen's College, Cambridge. And this is a very special episode today because this is in anticipation of Mohamed being one of our keynote speakers at the Digital Asset Summit that's happening in March 18th to 19th. We're going to be speaking there live. And for those that are listening, we actually have a special discount code for the conference. So if you go to the website in the show notes and get your ticket, if you use the code FG200, you'll get $200 off for the conference. So with that aside, Mohamed, it's an honor to have you on the show. How are you doing?
I'm well. Thanks for having me.
Yeah, very excited. It's been one of those weeks where it feels like decades happen, as they say, and there's been a lot going on. I want to start off the conversation by just digging into the jobs report that we had this morning. There's a few interesting data points that come in there. It feels like a mixed bag of results. I saw your tweet this morning where you mentioned how the non-farm payroll print did come in at 151,000, which was below the consensus forecast of 160. We saw the unemployment rate tick up. Most interestingly to me was that the U6 unemployment rate skyrocketed above the previous high back in the last fall. And notably, what you mentioned is around the participation rate that ticked lower. So I would love to just hear, how are you thinking about these different release points from the non-farm payroll print?
So as you said, it's been quite a week. And this one was not a huge surprise. There were little things, as you pointed out, that were notable, but we didn't miss in a big way as we've had in the past on job creation. So the job creation came in at 151,000. Consensus forecast was 160. That's within the margin of errors. Unemployment rate 4 to 4.1, not a big deal. Average hourly earnings came in as expected at 0.3. For me, the big surprise is that people dropped out of the labor force. And this speaks to a bigger issue as to if you go forward, are we going to see the weakness on the labor market, both on the supply side and the demand side, meaning less demand for labor and less supply for labor? That is part of a bigger story that people are starting to get worried about that was unthinkable a few months ago, which is this notion that we may end up in a world of stagflation. So this report was no big news. Let's get it out of the way. But there is a bit of anxiety about what's going to come next in the next few months.
Yeah, so my understanding is that the survey for the non-farm payroll came in during February 9th to 15th. So it missed a large chunk of what we've been seeing occur with federal government employees being laid off due to Doge. And to your point, it's a difficult market to lose your job in. The hiring rate is pretty lackluster. So is the main risk in that scenario is just these people dropping out and having trouble to find a new job effectively?
Correct. So the big risk is income insecurity. Whether you have a job or whether you lose your job, that you will feel that your future income is at risk. And you can see it. Certain people who were looking for jobs stop looking for a job because it's getting so difficult to find new jobs. If you lose your job, you can't find a job easily. And if you have a job, you become more insecure. So this notion of income insecurity is starting to become more important. And we haven't had to worry about this for a very long time. We've had a very strong labor market. And that is new, as is a decline in business sentiment. And these things are happening together. And that's why, in my own estimation, the probability of a recession has gone up from 10% to about 25 to 30%. It's not the baseline scenario, to be clear. It's still unlikely to happen, but it's a fatter tail than it was before.
Yeah, I want to dig into that a bit deeper. We got the Challenger data yesterday, and that was pretty interesting because I think a lot of the narrative right now is that most of the job losses is in the government sector. But what we actually saw in that is that it's actually spreading towards the private sector as well. Do you see that as being mostly attributed to the private sector uncertainty due to the government policy uncertainty that's occurring right now?
I think it's due to uncertainty part of which is coming from the trade side, part of which is coming from the public sector reform side, the DOGE side. Um, so the measures of uncertainty are at levels we haven't seen for a very, very long time. I was talking to a CEO yesterday, and he said, "I just want to know the operating environment in which I'm going to be living in. Just tell me what it's going to be, and then let me do my thing. But if I don't know what it's going to be like, let me just wait and see." And this phrase, wait and see, is starting to feature more and more in businesses.
Yeah, I've seen you mention and refer to it being as the risk of being stall speed as opposed to just a full on fall off of the cliff. What does that mechanic look like to go from why does the stall speed lead to the potential for the risk of a rollover there?
So think you're on a plane, right? Um, the plane needs to go forward. If it slows down too much, it doesn't need to go to zero, but if it slows down too much, it can't stay up in the air. Economies are the same way, especially the US economy. The US economy is used to growing, and growth allows you to do all sorts of things. It's like a business. When you grow, you can pay for your mistakes, you can experiment, you can do all sorts of things with growth. If you get to a world of low growth, then you can stall. And we've had the example, I'm not saying this is going to happen to the US, but we've had the example of Japan that stalled for a very long time. Because once you stall, people's expectations start working against you. Because once you stall, people say, well, maybe I should postpone my own consumption because the future looks uncertain. So you've postponed investment decisions, then I postpone consumption decisions, and next thing you know, we go from low growth to no growth. And that's the one thing we need to avoid. Now, what are the estimates? Let's put numbers on this. Last year, the US economy grew by 2.8%. Consensus estimates for this year were between 2.3 to 2.5. I think when we see revisions, they're going to be in the 1.5 to 2, and stall speed is anywhere below 1.
So I want to dig in a little bit deeper. You mentioned how the risk is of a stagflationary situation, which is I see that has come out a lot over the past year, but it feels like it's really starting to hit the data. So on Monday we received the ISM manufacturing data, and that was quite interesting because new orders fell off a cliff, but prices paid actually surged higher. How do you break down those different factors there?
So you're absolutely right. There were two disturbing data on the stag side. One, you mentioned it, which was new orders. The other one was employment. Then on the inflation side, prices paid went up by 7 points. That is a massive move. So what you're hearing is business are telling you that the input prices have gone up significantly, and they expect that to continue. Then businesses have to make a decision. Do they pass on that higher cost into higher prices or not? It will differ from company to company and from industry to industry. It's what economists call price elasticities. Our willingness to buy at higher price. Is it high? Is it low? If the seller thinks it's high, they will be more comfortable raising prices. But there's something else that has gone on. Businesses were caught by surprise, like many others, in 2021, 2022, with the surge in inflation. If you remember, the inflation rate went above 9%. Their cost went up at a higher rate. They weren't able to adjust prices quickly enough. Simple things like prices were printed on the tag. So you can't actually change your price, even if you wanted to. That has changed. A lot of companies now are much more agile when it comes to that price setting. So the concern that we all have is while growth is slowing down, companies will feel that they need to pass on the higher prices into high costs into higher prices. And of course, that's where tariffs play a major role, because people are worried that it won't be a once and for all effect. It may be a repeated effect. So there's a price level, and then there's an inflation effect.
So speaking on the tariff thing, I've been trying to piece through together. Obviously, we've been talking about the manufacturing PMI. Those have been sub 50 for almost a couple of years now. finally breaking higher, I've been trying to figure out, okay, is this a durable increase in the manufacturing sector, or is it a tariff front running situation? We've got the terms of trade data this week, and the deficit has just completely blown out. We've seen a huge surge in imports, and I'm trying to figure out, and I'm curious your thoughts that, we've obviously received the delay on the Mexico and Canada tariffs once again yesterday. So now we're in the situation where companies have front run a lot of imports, and if we get marginally less tariffs than what is anticipated, and we have all this inventory, all this imports coming onto the economy, what does that do to the growth outlook? Is that just a lot of sitting inventory that companies have to churn through? What's going to happen there?
So that's a great question. First, there's ample evidence that people accelerated their imports to avoid tariffs, and it's rational. If I tell you something's going to cost you 25% more, you will accelerate your purchase. There's also evidence that some companies have engaged in preemptive price increases. So they've increased their prices ahead of the tariffs. So whatever happens from now on to the tariffs, and it's uncertain what happens, there is this effect in there. What do people do with massive inventory? It depends who they are. If they're cash constraints, they flood the market. That's good for the consumer. That's bad for other producers. If they're not cash constrained, they'll just store it and let the inventory go as they would have otherwise.
Obviously, that leads to some potential headwinds for the growth outlook. And then I want to bring forth the other side of the equation. We've mentioned it a couple times, but obviously the inflation perspective. It feels like a lifetime ago, but the last CPI print we got was actually quite hot. There's a lot of people that are potentially looking through it. There's been some seasonality issues with the January, February data the last couple of years. So yeah, how are you thinking about the inflation outlook from here on out?
So we're going to get another print next week. I think what we know is the progress in reducing inflation has stalled. It has stalled. And the question is it going to go back up? Surveys suggest that people believe that. If you look at the surveys, there's been a massive move. The last one showed you that short-term inflation expectations have gone from 4.2% to 4.8%. That's a massive move in people's expectations. So people are expecting higher prices. It's not clear whether that's going to materialize or not, and we're going to look very carefully at this. Remember, if you step back, there were 5 policy issues identified by President Trump that would have an impact on the economy. One is energy, and we've seen a significant decline in energy prices. That is good for production. That is good for us when we go fill up our car. So that's the reverse of stagflation. That's a good positive supply shock. The second element is trade, and there the fear is that it will be stagflationary. The third element is forced repatriation of labor, and there's a worry as that could disrupt the labor market. We don't have any evidence for that. The fourth is DOGE, and this notion that we will get to a more efficient government. And when we get to a more efficient government, we can do better things, from reduce taxes, reduce debt, operate the public sector better. But the journey to that is going to be bumpy. So we're seeing the bumpiness now. We're not seeing the destination, we're seeing the bumpiness. And of course, the fifth thing is deregulation. And what is happening is there is a time inconsistency between the good things and the things that cause disruption in the short term. And I think that's what you're picking up in a lot of data, and we will pick that up in the data going forward.
I feel like a lot of the times when people hear the word stagflation, they think of the 1970s, and obviously that was related to the oil shock. But when I look at, we had the announcement from OPEC recently that they're going to be finally increasing supply, and you look at the oil price right now, and I'm wondering, do you feel like we can have? Is it possible to have an outright stagflationary shock when oil is hitting such high headwinds? Like it's not surge. We're not seeing oil at $100 right now. So can you really see that durable increase in inflation without that?
So first, it's interesting as you point out, that at a time when oil is under pressure, and yesterday both WTI and Brent were trading below $70 a barrel. So there's been a massive decline in oil prices to levels we haven't seen since 2021. So this is a significant fall. And it's a gift to the purchasing power of Americans. And it would have been unthinkable that in this world, OPEC would increase production. Normally, in this world, OPEC reduces production. So this is really notable. I'm glad you brought it up, and I think this has a political element to it. Um, part of President Trump's energy policy. Is it big enough to avoid a stagflation impact? No. It's helpful to avoid it, but energy costs are not as big a part of companies' bills these days as they were back in the 70s, and similarly with households. So it is positive, but it's not enough to completely compensate for all the other headwinds that we're facing right now.
When you reference that, it's more so in the framework that we're in a services-based economy than a goods-based economy. And to your point, like we got the ISM services PMIs, and those are actually pretty good. So it seems like, yeah, it's not as dependent on oil inputs.
You're absolutely right.
Yeah, got it. Okay, so speaking of the fiscal goals, we've had quite a few interviews from Treasury Secretary Scott Bessent recently, and there's a pretty consistent theme throughout all of them that they're trying to, basically have fiscal retrenchment, pull back the fiscal impulse, the fiscal dominance that we've seen over the past couple of years, and revitalize the private sector. And he mentioned it this morning, but he said there might be a detox period throughout that transitory time. So I'm curious, like, how do you think about it? It feels like there's a potential air pocket, and maybe that's what's got markets so worried right now, is that, long term, it's always great when you have an economy that's being led by the private sector, but we're in this very public sector dominant economy right now. So how do you think about that air pocket in the transition there?
Yeah, that's the difference between the journey and the destination. I use the simple example of taking my daughter to Disneyland every year when we lived in California. And of course, she would insist on getting there just as the park opened. So we would leave in the midst of lots of exciting, we're going to Disneyland, she would have her ears on and everything else. And then we would get in the car and we'd hit traffic, California traffic. So a journey that would normally take us 20 minutes would take us anything up to an hour and a half. So what would happen during that journey? First, I would hear 100 times, "Are we there yet? Are we there yet? Are we there yet?" irritating me. And then I would hear, because it's stop-go traffic, that I think I'm going to be sick, that I'm going to think I'm going to be sick, and sometimes she would get sick. So by the time we got to the destination, we had so mishandled the journey that the excitement about the destination wasn't there. And this is the risk we face right now. I think most of us would agree that getting to a slimmer government, a more efficient government, stopping this fiscal dominance, stopping this incredible dependence on the public sector to come in over and over again, is a good thing for the economy long term. But getting there is hard. And it is that bit of the journey, the detox period, as the secretary called it, that has to be handled really well. It wouldn't be a problem if there weren't other vulnerabilities in the economy. One is that already the low-income segment of the household distribution is under tremendous pressure. So the only thing that have kept them going is income security. If they have income insecurity, that could be a real problem for them and for the economy. The other is elevated asset prices, because when asset prices come down, you get the negative wealth effect. People, the well-off feel less wealthy, and they may spend less. We know that the positive wealth effect that we've had for a number of years has been consequential. So we don't want to try out a negative wealth effect. So you have these things coming together that makes the way you manage the journey really important.
Yeah, and it feels like through that journey, there's been a few mentions already from President Trump and Scott Bessent about how they're not looking at the stock market. They're not interested in it right now, as they potentially were in the previous administration. It feels like the shift of focus has gone towards the 10-year bond yield as opposed to that. Do you feel like they're underestimating the risk that if we get lower stock prices, it leads to that negative wealth effect loop, or do you feel like they're on top of it?
I don't know, but I do think that their view will change if we have evidence of a negative wealth effect. The last thing you want are negative income effects and negative wealth effects at the same time.
Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Erian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. So within this whole context, I want to hear about how you're thinking about the Fed stance as it stands right now. Obviously, back in December, we've seen what has been this stair-step sequence of what felt like a hawkish tilt. We're at a point right now where the forward prices on Fed funds futures has changed quite significantly. We're priced for 3 cuts now by the end of the year. Roughly a couple of weeks ago, we were only 1.5, something like that. So how are you thinking about the Fed stance right now? And then also what the market is pricing in terms of Fed cuts?
So I think the market pricing has gone from just over 1 to 3 because the market is suddenly recognizing that we may have a growth challenge. And we haven't had a growth challenge for quite a while. I go back in 2023, August, Chair Powell talks about pain to the US economy, mentioned it several times. In October, Bloomberg comes up with a headline, 100% probability of US recession. And we never fell into recession at all. We didn't even come close to falling into recession. Why? Because of the inherent strength of this economy. So there was a lot of confidence coming into this year that we will continue American economic exceptionalism and that growth will stay strong near 3%. And we've seen that shaken a little bit. And that's been a major change in the conventional wisdom. And when that happens, you saw, of course, the 10-year yield come down. You've seen stocks sell off. And that is right now the reason why people believe that the employment side of the Fed mandate is going to dominate the price side, meaning that the Fed is going to worry about what's happening to growth and will have to cut more than it would given what's happening to inflation, which has stalled in terms of progress. That's possible. I myself don't think you're going to get 3 cuts. Based on what we know today, I think we'll get 1 cut. But I don't think we're going to get 3 because I think the inflation issue is going to be a challenge to the Fed. The Fed is not going to look through the inflation problem because last time it looked through it in 2021, it made a major mistake. And you will hear over and over the experience of the 70s, the experience of the 70s. Be careful because if you let the inflation genie out of the bottle, when people have a recent history of inflation, then how inflation prone the economy goes up significantly.
I want to go one notch deeper on the inflation stalling out situation because, obviously we've seen most of the disinflation has occurred due to goods disinflation. Services have been quite sticky. There's been a lot of assumption baked in that, of that services component is the shelter data, owner's equivalent rent. There's been it feels like this constant promise that, oh no, it's just lagging and it's gonna head down lower and that'll bring us beautifully to this 2% range once again. Now the issue is that, as we've seen in the last couple of months of data, is that core goods has actually started to revert positively now. And so now the onus is on, okay, well, how much more shelter disinflation will we get? So how are you thinking about the 2 components and the 2 levers of like core goods heading up and shelter not coming down as much as some people might hope?
I'm thinking exactly as you framed it. And I'm glad you framed it that way because that's the best way to frame it. And very few people frame it that way. We had service inflation up here. We had goods disinflating. We had goods prices coming down. So even though this was coming down slowly, this was pulling everything down. Now, as you point out, this has gone up and this isn't coming down fast enough. And that's the problem. And then if you impose tariffs, there's a risk that this goes up even higher. And so that is the critical aspect. I think with time, services inflation will come down. The question is whether we can maintain the lid on goods inflation now.
How do you square that with what's happening in the broad housing market right now? It feels like, obviously supply is increasing quite significantly. Mortgage rates have come down a little bit, but, we're still at the standstill where nobody really wants to change houses, buy, sell. Really, it's just kind of frozen. Do you feel like you could see that being unfrozen in the near term future? And could that have an impact on shelter as it starts to trickle into the data?
So historically, when you take mortgage rates up violently, which we did, remember, because the Fed was late, the Fed had to hike much more than would have had to otherwise. So the rate structure moved a lot higher than people would have seen it otherwise, and that causes the market to freeze a little bit. If you are in a low rate mortgage, you've got to be really convinced you want to move out of it, because you're going to recontract at a much higher interest rate, and your housing costs for the same unit of houses is going to go up significantly. So hopefully, and that's why I think, as you said, the Trump administration is focused on the 10-year rate. It's the notion is, if you can bring down the 10-year rate, you will bring down mortgage rates with it, and then you can lubricate the economy again.
Okay, I want to shift our perspective to the global economy because there's some interesting cross currents happening there right now. So obviously, the way I view it right now is if you just look at the economic surprise index of, say, the US versus Europe or Japan, the US is heading down. Europe and Japan, they're heading upwards. They're actually going on an uptick. And not only that, but we're starting to see some pretty significant unshackling of the fiscal, especially in Europe right now. We got an announcement from Germany that they're looking to provide a fiscal impulse of upwards of 500 billion, I believe. And so I'd be curious to hear about how are you thinking about that? As it feels like the last decade or so has just been this theme of European stagnation, and there's been a lot of widowmaker trades trying to say that it's different this time. So is it different this time for Europe?
This is a really good question. I used to have a simple answer, which is it's not. I used to have a simple answer saying the good, the bad, and the ugly in my mind are unambiguously the following. The US is the good economy, China is the bad economy, and Europe is the ugly economy. And all the data was confirming this, and everything was fine, and that was going to continue. And then Europe got delivered what's known as a Sputnik moment. I don't know if you know the Sputnik moment, but that's when the US was woken up, if you like, by the Soviet Union, the evil empire, as Reagan said it, sending up a satellite into space. And then we realized we had to do something different. I think Germany has realized it has to do something different. So the talk has completely changed. It is about removing the self-imposed debt brake. They have massive fiscal capacity, but there have been no willingness. They have the ability, but not the willingness. We're going to increase defense spending, which was unthinkable. We're going to increase infrastructure spending, and we are more open to pay for Europe-wide projects. That is a complete transformation. So far, it's limited to words. Now, the markets have gotten really excited, and all the trades that were so obvious a few weeks ago have been upended. It was so obvious that the euro was going to weaken. Some people are talking about parity. Well, the euro had the strongest week in almost 20 years, and we're now almost at 109. It was so obvious that US interest rates would stay up here, whereas German interest rates would stay down here. Guess what? That gap has narrowed tremendously because German rates have moved. In one day, we've got a 30 basis point move. We haven't seen that since reunification of Germany. It was so obvious that European equities will underperform relative to the US. Well, guess what? They've outpaced the US enormously. So the market has priced in not just different words, but different actions. And that, for me, is still a question mark, because there's a lot that has to change in Europe. And I don't know whether it's going to come as fast as the market's expecting.
Yeah, it feels like the big question mark is how on board the European Union and Christine Lagarde will be with this for how it gets financed. How are you thinking about, do you think Lagarde is on board with this? Do you think the European Union as a whole is on board with this, or is it still just isolated to mostly Germany? I've seen some whispers of it in France too, but yeah, do you feel like we need that broad consensus from the top orgs?
Yeah, and the newly elected prime minister in Germany was very smart in using the exact words that Mario Draghi, the president of the ECB, used in 2014 when he said, "Whatever it takes." Right? I don't think it was a coincidence that he used those exact words. I think the ECB will be supportive. So supportive in two ways. You're going to see further cuts in interest rates, and they'll be open to slow down their QT, the contraction in their balance sheet, if they feel that market rates have gone too high. But I wouldn't go much further than that.
And then what's your perspective on Japan and China right now? Obviously, China has just been in a somewhat of a deflationary spiral a little bit. It feels like everybody's waiting for that big fiscal unshackling over there as well. We've seen a lot of monetary work so far, but it feels like a lot of people are waiting for that. So yeah, what's your perspective on China and then also Japan?
So China right now is in a muddled middle on policy, and for good reason. Like you say, a lot of people say, just do the bazooka stimulus, throw everything at it. Otherwise, we're going to be Japan, and we don't want to become Japan of old. But the authorities know that their growth engine is outdated. So if you simply crank out an outdated growth engine, you get a lot of unintended consequences and collateral damage. The other side is reforms, deep reforms to your growth engine. But that means slower growth in the short term. So they look at this and literally they do a bit of this, a bit of that, and they hope that these two things will add up to 4.5% to 5% growth. But they never get out of the situation they're in. And that's why we've seen this hesitancy, as you point out, on the part of the Chinese household sector in particular to spend. And the government is trying to encourage them to spend. But what they're doing is they're self-insuring. They're self-insuring against the fact that they may stay in the muddled middle. In the old days, China would clearly go for the long-term play, reforms, etc. But for some reason this time, they are much more uncertain. Japan is finally emerging from this multi-decade low-growth equilibrium. The Japanification of its economy is being left behind. And we're seeing things that were unthinkable. The 10-year yield is at 1.5%. That's a tripling in a year of that yield. We're seeing wage demands that are huge. Why? Because we're seeing inflation like we've never seen before. We're seeing growth pick up. So I think Japan is finally exiting the multi-decade low growth equilibrium.
Mohamed, my final question for you is actually shifting quite a bit towards digital assets and Bitcoin. So yesterday we had an executive order from President Trump formalizing this idea of a strategic Bitcoin reserve. I'd be curious, what is your high level framework for how you think about Bitcoin within a macro framework and its validity for fiscal governments?
So I think Bitcoin is finding its identity. And its identity is going to be somewhere between liquid gold and some other asset. It will play a role in the payment system, a notable role in the payment system. It will have deeper adoption by institutions, something that started about a year ago and will accelerate. It will feature like gold features in the portfolios of many, many, many more people. So adoption will continue. The two question marks is regulation and international harmonization of regulation. That we don't know how they're going to happen. I still am not in the camp of those who believe that this is the next world currency. It could be, but I don't think there's enough evidence there to suggest it's going to happen. We are going towards a more fragmented system where Bitcoin will be in that ecosystem. But do I think the dollar as the reserve currency will be displaced by Bitcoin? No. Some people believe that when they say it's the world currency. I think that countries will be very hesitant to let that happen. But I do see it as part of the ecosystem, and I do see greater adoption. And the only question mark is about national and international regulation.
Mm-hmm. Well said. Well, Mohamed, it was an absolute honor to have you on the show. This is a great teaser of what will be coming up at the Digital Asset Summit. So be sure to get your tickets to hear both of us live on stage there in a couple of weeks' time. Again, we do have that code for FG200 to get a discount off your ticket. It's going to be a blast. And thanks again, Mohamed, for joining us. That was fantastic.
I'm looking forward to it. Thank you so much for having me.
Thank you.